بسم الله الرحمن الرحيم والصلاة والسلام على أشرف المرسلين سيدنا محمد النبي أمي وعلى آله وصحابته أجمعين. Today, inshallah ta'ala, we are going to discuss one of the important chapter in finance, which is necessary for financial decision. This chapter is going to discuss the meaning of risk and return and the relationship between them and the importance of considering such a relationship in any potential financial decision. In this chapter, one of the first learning objective is to understand the meaning and the fundamentals of risk, return, and risk preferences. Number two, describe procedures for assessing and measuring the risk of a single asset. First of all, in most important business decision, there are two key financial considerations: risk and return. But when you would like to support any financial decision, you must try to consider the risk and the return and the relationship between them. Why? Because number one, each financial decision presents certain risk and return characteristics. Sometimes you could find the risk of a specific financial decision is high, or sometimes a risk related to a financial decision is low. Therefore, it's necessary for consider the combination of these characteristics, which can increase or decrease a firm share price. Of course, increasing level of risk will affect negatively on a market share price of a specific organization. Therefore, considering the relationship between risk and return, it's very important for a firm share prices. Therefore, a lot of researchers are interested to quantifying this type of risk, and this quantification is extended for a single firm asset, or if we are speaking about groups of assets, which is known a portfolio. Therefore, in this chapter, we are going to quantify the risk. One time, if we have a single asset, عندنا أصل واحد, أو if we have a group of assets which are known as a portfolio. First of all, if someone is asking me, what is the definition of risk? Risk, it's a measure of the uncertainty surrounding the return that an investment will earn. Such a type of uncertainty could be high or could be low, which can be defined as a variability of return associated with a given asset. Risk, it's a measure of uncertainty, or it's a measure of the variability of returns associated with a given asset. On the other hand, when I'm saying return, what is a return? A return is the total gain or loss experienced on an investment over a given period of time. This means that a return could be positive if there is a gain, or a return could be negative if there is the loss. But how could we calculate the return? The return could be calculated by dividing the asset cash distribution during the period plus a change in value by its beginning of a period investment value. This means that if there is an asset and we are interested to calculate the return earned on this asset over a period of time t, in this case RT is equal to CT plus BT minus PT minus 1 divided by PT minus 1. R, this is the required rate of return during period T. This is the expected rate of return, required rate of return, expected rate of return. What is C? C, this is the cash received from the asset investment in the time period between T minus 1 and T. This is the cash received. This cash received could be in a shape of dividend or could be in a shape of coupon. What is BT? BT, this is the price of the asset at time T. PT minus 1, this is the price of the asset at time T minus 1. Based on this equation, let us take the following example. How could we calculate the expected rate of return or the required rate of return? Imagine that at the beginning of the year, Apple stock traded for 90.75 per share. Walmart was valued at 55.33 during the year. Apple paid no dividends, but Walmart shareholders received dividends of 1.09 per share. At the end of the year, Apple stock was worth 210.3 and Walmart sold for 52.84. To determine the expected rate of return or the required rate of return for Apple share and Walmart share, this will be as follows. For Apple, the expected rate of return is equal to the expected dividends during the year. In this example, it is 0. Plus PT, this is the price at the beginning this is the price at time T. PT minus 1, this is the price at T minus 1. So PT in this case, this will be the price at the end of the year, which is 210.73 minus the price at the beginning of the year, which is 90.75 divided by 90.75. So this will give 1.322%. The same situation for Walmart. You will find that the expected or the required rate of return is negative. As you see, the expected rate of return or the required rate of return could be positive or could be negative. Actually, we have different types of interest rate, especially a historical return. One of them, it's called real rate of interest. Second one, it's called nominal rate of interest. What is the basic difference between them? The real rate of interest, it refers to the rate that creates equilibrium between demand and supply for a specific investment fund in a perfect world. So the real rate of interest, it reflects the rate which creates equilibrium in a perfect world without inflation, where demander and the suppliers of a specific fund have no liquidity preferences and there is no risk. يبقى the real rate of interest, it's a rate, it's expected to be earned if there is no risk. But this is not realistic, because in every world, in every country, you could face a certain level of risk. So if you are going to face a certain level of risk, you must earn a specific compensation for such a type of risk. So the nominal rate of interest, it's equal to real rate of interest plus the compensation for bearing a specific type of risk, and this is the nominal rate of interest. The basic difference between real rate of interest and nominal rate of interest, real rate of interest, it reflects the world without inflation, reflects a world without risk. But nominal rate of interest, it reflects a certain level of inflation rate, it reflects a certain level of risk, so you must get a compensation for both of inflation and a compensation for bearing a specific type of risk. This will be a nominal rate of interest. This is why in most of cases you will find that the nominal rate of interest is higher than the real rate of interest. And here, this is an example. This is the historical return on selected investment. You will note a basic difference between average nominal rate of return and the average real rate of return. For example, in TB, Treasury bill, the nominal rate of return is 3.9%, but in the case of the average real rate of return, it's 0.9%. A Treasury bond, the average nominal real rate of return, about 5%. Its average real rate of return, it's 1.9. In common stocks, the average nominal rate of return is 9.3. The average real rate of return is 6.2. And this is very important to differentiate between the concepts of real rate of interest and nominal rate of interest or nominal rate of return. Why we have always difference between them. Also, for you as a financial manager and investor, you need to consider also the concept of risk preferences. Risk preferences, this is a concept, reflect and describe how investors respond to risk, because not every investor is the same in their behavior towards risk. There is differences, and these differences must be considered by the investor and the manager when we're dealing with different investors. One type of risk preferences, we could describe them as risk averse. Risk averse هو كاره أي مخاطر. Risk averse. Risk averse is attitude toward risk in which investor would require an increased return as compensation for an increase in risk. Yani by nature, such a type of investor, they didn't like risk. However, they could accept high level of risk if there is increase in the return as a compensation for such a type of risk. Second one, it's called risk neutral. شخص محايد تجاه المخاطر. What is the meaning of risk neutral? It is also attitude toward the risk in which investor choose the investment with the higher return regardless of its risk. يعني بغض النظر عن المخاطر بتاعتها بيختار دايما أي استثمار ذو أي عائد أي مرتفع. ده احنا بنسميه يا جماعة ريسك نيوترال. يبقى ريسك نيوترال هو أي الشخص أي محايد تجاه خطر، يفضل دائما الاستثمارات ذات عائد مرتفع بغض النظر عن درجة أي مخاطرة. The third type of investor could be described as risk seeking. Risk seeking يعني أي مستثمر أي مغامر أو أي محب للخطر. What is the risk seeking? Risk seeking it's an attitude toward the risk in which investor prefer investment with a greater risk even if they have lower expected return. يعني يفضلوا أي مخاطر أي مرتفعة حتى ولو كان عائد منخفض. طب ده مهم. Is this important? Of course, because you in a market you are going to deal with different investors. They have different risk preferences. The decision will differ for each one of them. So first of all, you must study the main characteristics of each one of them, because based on these characteristics, this will help you to support the right decision for each category of those investors. يبقى بشكل مختصر ان احنا عندنا اي مستثمرين يختلفون في تفضيلاتهم. النوع الأول هو الريسك افيرس. النوع الأول هو الشخص أي كاره للمخاطر. هذا الشخص دايما يحب المخاطرة ولكنه على استعداد لتحمل مخاطر مرتفعة في مقابل زيادة العائد المتوقع كتعويض عن هذه المخاطرة. النوع الثاني ريسك نيوترال هو الشخص المحايد تجاه المخاطر. هو بطبيعته يفضل الاستثمارات ذات عائد أي مرتفع بغض النظر عن درجة المخاطر. يعني المخاطر is not in his mind. آخر حاجة الريسك seeking هو المستثمر أي مخاطر. هو ذلك الشخص he is seeking for high level of risk even if they have lower expected return. دايما يحب المخاطر حتى ولو كان عائد المتوقع منخفض. A most important thing when we dealing with the risk is to quantify this type of risk, to determine what is the level of risk. And in this case, we have different approaches for assessing the risk. It's called risk assessment. One of the method that could be used for risk assessment, it's called scenario analysis. تحليل سيناريوهات. Scenario analysis, it's an approach for assessing the risk that use possible alternative outcomes. يعني under different scenarios to obtain a sense of the variability among the return. One of the common methods is to consider a pessimistic condition, a most likely condition, optimistic condition, and the return associated with them for a given asset. يعني we try to investigate the return of the asset under different conditions such as optimistic condition, pessimistic condition, most likely condition. يبقى تحليل السيناريو بيحاول انه يدرس هي عوائد المتوقعة يقص تحت مجموعة من السيناريوهات. اشهر هذا الشيء ان احنا بنفترض افضل الظروف، اسوأ الظروف، اكثر الظروف احتمالا، ونحدد the expected or the required rate of return under each one of those. The second method for assessing risk, it is called range, أي مدى. And as you know from the statistics, range, it is the difference between the highest EV and the lowest EV, or the best EV and the worst EV regarding the rate of return. Increasing the difference between the highest and the lowest, or increasing the EV between the best and the worst, this is called أي مدى. This range, increasing the range means increasing risk. But range, it's a measure of an asset risk which is found by subtracting a return associated with the mathematics worst outcomes and then determine the EV of the risk. Example for it, imagine that we have two assets, asset A and asset B, and we have the annual rate of return under different conditions. One of the first condition is the pessimistic condition, second one is the most likely condition, and the third one is the optimistic condition. How could we determine the range? The range will be determined through find the difference between the highest expected rate of return and the lowest rate of return. In example, in the asset A, the highest EV of rate of return is 17%, minus the lowest rate of return is 13%, so this range is 4%. The same situation for asset B, the highest rate of return for asset B is 23%, minus the lowest rate of return for asset B is 7%, so the difference, it's called the range, which is 16%. As you see, increasing the range, it's a reflection of increasing the risk. So based on this solution, we could conclude that asset B is risky than asset A because the range of asset B, 16%, is higher than the range of asset A, which is 4%. بشكل مختصر، أي مدى هو يفارق بين أعلى قيمة وأقل قيمة لعائد أي استثمار في ظل ظروف مختلفة. كلما زاد أي فارق كلما زادت أي مخاطرة. Also, to assess a level of risk, we could use a graphical solution. And the graphical solution try to figure the probability distribution of the rate of return related to this asset. One of the methods for determining or for assessing the risk is to figure out the probability distribution. What is the probability distribution? التوزيع الاحتمالي. It's a model that relates a probability to the associated outcome. In this case, could be reflected in two shapes. The first one using what we call bar chart. What is a bar chart? This is a very simplest type of probability distribution. It only shows a limited number of outcomes associated with the probability for a given event. Or we use what we call a continuous probability distribution. A continuous probability distribution, it shows all possible outcomes and the associated probability for a given event. But how could we use a bar chart and a continuous probability distribution for risk assessment. This could be done by the following example. Example number one, Norman Company past estimates indicate that the probability of the pessimistic, most likely, and the optimistics are 25%, 55%, and 25% respectively. يبقى ده أي احتمال في حالة الظروف أي أكثر رواجا في حالة الظروف السيئة أو في حالة الظروف الأكثر احتمالا عندي أي probability أي خاص بها. In this case, how could we figure out these things? The first approach is to use what we call the bar chart for each asset. For example, here we have two assets. This is asset A and this is asset B. And in asset B, I'm trying to figure out إن أنا أرسم العلاقة between a return and a probability of occurrence احتمال الحدوث. For asset A, the same situation, I try to figure out the bar chart by finding a relation between the return and the probability of occurrence. From two shapes, you will find that a dispersion around the mean in asset A is less than a dispersion. درجة التشتت in asset A is less than a dispersion التشتت in asset B. So we could conclude that asset A is less risky than asset B. This is using a bar chart. يبقى عن طريق الأعمدة البيانية بنحاول نوضح العلاقة بين عائد كنسبة هو rate of return واحتمال الحدوث هو probability of occurrence. After we figure them, we give a look for the figure and see the level of dispersion, درجة التشتت around the mean. Increasing the dispersion around the mean means increasing the risk. كل ما زاد درجة التشتت كل ما زاد الريسك. This also could be determined by using, instead of using a bar chart خريطة بيانية أو أعمدة ممكن نستخدم ما يسمى the continuous probability distribution. The continuous probability distribution, we also try to figure all possible outcomes and its probability of occurrence احتمال الحدوث. As you see, this is our return, all of the expected return, and this is the probability density. As you see, this is asset D and this is asset C. So you will find that the asset C, which is in a brown color, this asset C is more a density than asset D, or a dispersion of asset D is higher than the dispersion of asset C. So we could conclude that asset D is more risky than asset C. As you see, to assess the level of risk or the risk assessment, we have different methods. One of them is the scenario analysis. Second one is to use a range. The third one is a graphical solution, either by using a bar chart or using the continuous probability distribution. However, some people didn't prefer such a method, and they suggested the fourth one, which is using standard deviation as a measure of the risk. What is sigma? Sigma standard deviation is the most common statistical indicator of an asset risk. يبقى لما اقول اي خطر بتاع asset او بين قوسين اي مخاطر اي كلية اي asset اي مخاطر كلية could be measured ممكن نقيسها by the standard deviation. What is the standard deviation? Standard deviation, it's a measure of the dispersion around the expected value. يبقى measures the dispersion around the expected value. Therefore, to determine sigma, عشان نقيس السيجما, it's a measure the dispersion around the expected value. So we need first to determine what is the expected value. The expected value of the return, which we refer to it by R bar. When I say R bar, this is the expected value. But how could we measure it at the expected value? If the rate of return of the asset has equal probability, in this case, the expected R bar, it is the sum of the rate of return at different conditions divided by N. But if there is differences in the probability of occurrence of each rate of return, in this case R bar, which is the expected value of return, is equal to sum of the product R multiplied by B. What is RJ? RJ, this is the return of the J outcome. What is PRJ? This is the probability of the occurrence of the J outcome. What is N? This is the number of outcome outside. How could we explain this? Let us take an example and show you how could we determine the expected rate of return. Here we have two assets, asset A and asset B. In asset A, we have a different rate of return under different conditions. We have pessimistic condition, we have most likely condition, and optimistic condition. The probability is 0.25 for the pessimistic, 0.50 for the most likely, and 0.25 for the optimistic. And also we have different returns attached to each one of such a condition. To determine the expected rate of return, number one, we multiply the probability of occurrence by the rate of return to determine what we call the weighted value. So 0.25 multiplied by 13%, this will give 3.25%. The same situation, 0.50 multiplied by 15%, this will give 7.5, and then we taking a sum, so the sum it will be our expected rate of return. It was the expected rate of return in this case is 15%. The same scenario will be for asset B. Asset B, we have different rate of return for different conditions. These conditions, it extends from pessimistic, most likely optimistic. First, we multiply the return by its probability and then taking a sum. In such a situation, we must note that يجب أن نلاحظ أن expected rate of return for asset A equals the expected rate of return for asset B. After we determine the expected rate of return, then we must determine sigma standard deviation. What is sigma? Sigma R, this is the standard deviation of the rate of return of acid A. Sigma, it's equal to root square sum of Rj minus R bar square multiplied by probability of Rj. Increasing sigma means increasing the risk. So in general, the higher the standard deviation, the greater of the risk. كل ما زادت السيجما كل ما زاد درجة المخاطر. بالتطبيق هي this is acid A. In acid A, this is my Rj. To have it Rj minus R bar, يبقى in this case we set R bar, then we take a difference between Rj R bar. مش كده؟ انت عندك المعطيات Rj وانت حسبت R bar which is 15%. أي خطوة رقم واحد انك تجيبي فارق the difference between Rj minus R bar. Then you squared it. يبقى Rj minus R bar squared. Then in our equation we have a Brj. This is given. We must multiply Brj by a squared difference Rj minus R bar, and then we taking a sum, and this sum under the root square, it will give you 1.41%. يبقى again we have given عندنا معلومات معطاة Rj 13 15 17. الخطوة رقم واحد لازم نحسب expected rate of return which is 15%. بعدين نوجد الفارق بين كل واحد منهم ثم نقوم بالتربيع ثم نضربه في probability وبعدين ناخد مجموع عمودي أخير under تحت أي جذر إذن بيعطيك ما يسمى بالسيجما. يعطيك ما يسمى ب يا جماعة يعطينا ما يسمى بالسيجما. In this sigma for A, it's an indicator of the level of risk related to A. The same situation for B. First, and then a return. We have the expected return. We find the difference, squared it, then multiply it by the probability, taking the sum under the root square, then we get the level of risk, which is 5.66%. Based on our calculation, we found that sigma for acid B is higher than acid A, so we could conclude that acid B is more risky than acid A. And this table reflects exactly a relation between risk and return. We explained before that we have a positive relationship between the risk and the expected rate of return. Increasing level of risk lead to increase the expected rate of return as a compensation for bearing the risk. Here, give a look. Treasury bill. I think everyone should know what is the meaning of a treasury bill. This is the short-term assets. Short-term assets with the maturity less than 1. Because this is short-term asset with the maturity less than 1, so its risk is a little bit small. This is why its standard deviation it is 4.7%. And its expected rate of return, which is the average nominal rate of return, is 3.9%. Second one, treasury bond. This is a long-term asset. Long-term asset, we agreed that increasing a maturity lead to increase a risk. So this is why you will find that the standard deviation it's 10.2. 10.2, which is a reflection of increasing a risk. And finally, the common stocks, which is more risky than the other type of investments. This is why the standard deviation is 20.4, which is greater than the other types, and this is why the expected rate of return or the average nominal rate of return is 9.3. There is something I would like to attract your attention for it. Imagine that we have two assets, asset A and asset B. In this example, when we measure the expected rate of return for each one of them, we found that the expected rate of return for each one of them is 15%. It's equal. Equals, this means that when we would like to compare between them, we could depend only on the standard deviation because both of them are equal regarding the expected rate of return, so we could only depend on sigma for differentiating between the two assets. But the problem would appear if the expected return and a risk for each one of them are different. In this case, how could we compare between two assets? Expected return are different, or risks are different. In this case, it will be very hard or difficult to compare between them only based on the expected return. It will be also difficult to be compared between them based on sigma. So in this case, we must have a new measure for a comparison between the two assets, and this a new measure, it's called coefficient of variation. What is the coefficient of variation? معامل اختلاف. Coefficient of variation, we refer to it as CV. CV, C capital V. يبقى CV, this is a coefficient of variation. It's a measure of a relative dispersion, which is useful in comparing the risks of assets with different expected rate of return. If we have two assets and those two assets have different expected rate of return, to compare between them, you must calculate CV. CV is equal to sigma, the standard deviation of the asset, divided by its expected rate of return. As we agree, a higher coefficient of CV, this means that the investment has more volatility, has more risk relative to its expected rate of return. So imagine that in this example, we would like to implement the coefficient of variation. So the CV for asset A is equal to sigma divided by its expected return. So 1.41% divided by 15%. The same situation for asset B, which is equal to 5.6% divided by 15%. As you see, increasing or higher level of CV reflect high level of risk, so we could reach to the same conclusion that B is more risky than A. B is more risky than A. Another example for assessing risk. Imagine that this is stock price over 3 years, 2010 to 2012. You have the beginning stock price value and you have the end stock price, and also you have a dividend paid at the end of the year. The question is measure the risk or assess the risk for such investment. The first step, we must determine the return, and we agreed that a return is equal to C plus PT minus PT minus 1 divided by PT minus 1. So this means that in year 2010, CT, which is the dividends, which is 3.50 plus PT, this is the price at the end of the year, which is 36.50 minus PT minus 1, this is the price at the beginning of the year, which is 35, all over divided by 35. In this case, the expected rate of return is 14.3%. The same will be for 2011 and 2012, which will be 4.1% and 13% respectively. Then we determine the expected rate of return. The expected rate of return over the 3 years. Because the rate of return at each year will occur at the same probability value, so we have equal probability distribution. In this case, the expected rate of return over the 3 years could equal sum of the return divided by n. So we take 14.3% plus 4.1% plus 13% divided by 3, which is the average of the required rate of return or the expected rate of return, which is equal to 10.5%. Then to determine a sigma over the 3 years, this sigma is equal to root square of 14.3%. This is the rate of return at the first year minus the expected rate of return, which is 10.5% power to 2 plus the same situation 14.3% minus 10.5% square plus 13% minus 10.5% square, and then we divided this total by n minus 1, which is 3 minus 1, and this way under the root square, this will give you sigma is 5.6%. To determine the CV, a cross of variation, in this case CV is equal to, coefficient of variation, CV is equal to 5.6%, which is sigma, divided by the expected rate of return, which is 10.5%. So the level of the risk in this case is 0.53. If you have another investment, you compare CV with the CV of the other investment, and the higher level of CV is an indicator of increasing the level of risk. So by the end of this lecture, you must aware of what is the meaning of the return, what is the meaning of the risk, how we could measure the risk for a single asset. Number one, under a different scenario analysis, using a range. Number three, using a sigma. To measure sigma, we need to determine the expected value of return or the average of rate of return, and then we determine sigma. Increasing a sigma means increasing the level of risk, and then you must aware of the CV and when we use a coefficient of variation for a comparison between different projects. I wish for you all of the best and thank you, and waiting you in the second part of the relation between risk and return in the next lecture إن شاء الله تعالى وشكرا.